The global financial markets have become a gambling house for millennial traders. How did this happen? Well, Jaime Rogozinski, our next guest, is here to explain just that. Jaime is the author of WallStreetBets, How Boomers Made the World's Biggest Casino for Millennials. And Jaime is also the founder of WallStreetBets, a popular subreddit forum on which the book is based. WallStreetBets is one of the largest forums on the internet for discussions about finance and trading in the world. It has close to 2 million followers on Reddit already as of today. Jaime, welcome to Kitco. It's a pleasure speaking with you.
Hi, thank you for having me. It's a pleasure to be here.
I get this question from my peers and my friends who have followed WallStreetBets for many years, and their first question is always, can you please ask Jaime for his inspiration behind WallStreetBets? What inspired him to start this thread that has now become a global phenomenon, almost a cultural movement amongst young millennial traders?
Well, to be fair, I get asked that question a lot too. The inspiration was a vacuum of a space for people that were looking to get involved with the markets in a way that was more aggressive, meaning more risk, more reward, and at the same time wasn't a full-time profession. That's to say, there was either places where you can discuss passive investing, right? Usually takes the form of indexing and long-term time horizon, or full-time professional traders. These are people that work at prop shops or big investment firms. There was no spot for people that just wanted to actively manage, so I started WallStreetBets. And the name I gave it was basically because of the inspiration of taking higher risk. Whenever I was in forums that were discussing regular investing, and I would say, hey, what do you guys think of this and that stock or whatnot, people would say that's too risky, you're gambling with the market. So the name I gave it wasn't really with the intention of having it be a casino, but it was to try and push away any critics of discussing high risk strategies.
Yeah. Has it evolved? Has the subreddit evolved in a way that you had anticipated when you first founded it?
There's elements that have evolved. There's elements that have always been there. The overall attitude, the feel of people that are taking risks and taking them very lightly, that's always been there. The evolution definitely has taken place from a place where people go there to actually learn. They approach the forum with questions about, okay, well, what do you guys think about this? Or if I want to use the stock options during earnings, what could potentially happen? To a place where it's just the risk. Let's get rid of the thought process behind it. Do we think it's going to go up or down?
Yeah, okay. Let's talk about your book and the themes behind the messages of your book. Now, your book is called, once again, WallStreetBets, How Boomers Made the World's Biggest Casino for Millennials. Can you explain, first of all, what the title means? How is it that boomers have created a vacuum for millennials to come in and fill this void for gambling, Jaime?
Well, they did a couple of things. Number one, they made normal gambling illegal or very difficult. Not until recently were you able to bet on sports. And even still, it's kind of a shady area. Physically betting in places still is really tricky. You have to go to certain states or riverboats or whatnot. So they set up the infrastructure around the legal framework, and they also created a poor example that breeded mistrust. They were in charge of they were in charge when the dot-com bubble busted. They were in charge of the 2008 fiasco, and the millennial generation got to see, while they're still in school, not participating in the workforce, what's happening to their parents or older people at their houses are going upside down. So they lose a little bit of respect, or a lot of respect, for the whole system of Wall Street. So you have this mistrusting idea. You also give them a difficult financial landscape to work with. A lot of these kids, when they're leaving college right in the middle of the last financial crisis, they're having difficulty finding employment or well-paying employment. So they just think the whole thing's a joke. They finally end up doing better. They end up making some more money. They're looking for something to do with it. They don't trust that if they stick their retirements into the stock market, that it's going to be different this time. So if you can't beat them, they join them.
Okay. Now, one of the themes that you've discussed in your book is that the global financial system has now become, in your words, a legal conduit for gambling. It's like the stock markets are a casino. Now, first of all, is this, in your opinion, is this a recent development? And to what extent does this have any significant impact on global financial markets, the way people trade now, the attitude towards trading?
Nothing has changed to make the market a casino. I guess it's always had really similar structure to it. What was missing was the access to the market. If you wanted to participate in trading stocks, the first time I traded a stock back in 2000, let's go with 6, I bought shares of Google. It cost me $30 commission to buy and $30 commission to sell, and I had to go. It's a huge burden. It's a barrier of entry was really high. Nowadays, you download the app on your phone, pay 0 commission, you fund it instantly, and you start playing what appears to be a video game with access to super complicated instruments that are either highly leveraged or very complicated to understand, but they come with big arrows and confetti animations. So I think it's the access to the market. So the participants, the barriers of entry get lower, the minimum account balances get lower, the cost of playing is almost null. Even if you don't play with stock options, you have fractional share prices.
Yeah.
So anybody with any money, with any cell phone is able to play with it. So now so now you're mixing a world where you still have professionals that are taking it seriously. You have still some professionals that are taking risks akin to gambling, but now you also have a huge population of what's called retail amateurs, millennials, whatever name you want to give them, and they're really mixing it up. And because they come in huge amounts of volume, especially this year, we see that they're actually affecting the markets, right? We've seen what they've done with very notable examples, especially this year.
Yeah, one of the things that traders have done is exploit some of the loopholes in Robinhood. So a few users actually on WallStreetBets have posted about their gains and their losses and how they're able to use their, this one particular loophole allowed you to use the premiums you got on trading options and selling options to actually adding to your equities position, and thereby your margin account grew from potentially $1,000 to $50,000. That's a significant amount of leverage, and they're able to utilize this method to their either late gain or the loss. A lot of people did lose even more than they started off with by a significant margin. Do you think that, my question is, do you think that retail trading and investing, especially on apps and trading platforms like Robinhood, should be more regulated?
I mean, they should. Okay, so to be clear, these exploits were exploits, right? They weren't necessarily something that should have happened. Any other broker would not have permitted that to happen. That was an oversight, and it's an oversight of the regulation. The regulation prohibits that type of leverage, and the biggest profile was a guy that took $2,500 and leveraged it up to $1 million, which is very dangerous. So as far as the regulation is concerned, it's already there. I guess it's more the enforcement of the regulation. When it comes down to protecting the investors, I suppose but they know what they're doing. When you take a $2,500 position and you leverage it up, you can't play dumb and say, I didn't realize what I was doing. In fact, that's the intention of what it is that they're doing. And to some extent, and it's almost ironic, right? When you look at large institutions that behaved irresponsibly in 2008 with these fancy mortgage-backed securities, these big derivatives and whatnot, they ended up basically crashing the entire system. They didn't end up having to pay for that. They had to get bailed out. So their risk involved was non-existent. Mm-hmm. These kids that are playing like this, I guess it depends on each one what ends up happening, but a lot of these guys don't have $1 million. So I guarantee you they don't need the cost They just give it to somebody else. It's just like the bigger banks were able to do that previously.
Yeah. In your book, you've also used a variety of anecdotes to illustrate your point. Can you share with us some of these anecdotes? What are some of the stories that you've seen on this subreddit that really struck out to you as something memorable, something that you wouldn't have expected people to do?
My favorite all-time anecdote, and it's going to be really hard to break because it almost deserves a book of its own.
Yeah.
This was about almost 2 years ago, before this so-called infinite margin glitch. This one individual actually started that same exploit to a different extent because there wasn't margin back then. He still was able to lever up an infinite amount if he really wanted to, but he ended up stopped, to quote him, because the market closes at 4 o'clock. So he was leveraging up that particular day, starting with a small cash amount. And he was using something called box spreads. And I won't get into the technicals of it, but it's kind of a tricky options strategy. And he kind of found a little loophole where the Robinhood wasn't accounting for the collateral necessary for it. And so he ended up getting this massive position, hundreds of thousands of dollars, on what he considered to be a risk-free position because of what the textbooks tell you what should happen. And he was doing this position on something that's called XIV, which is this ETF on the VIX. And now we're talking about synthetic products that are tracking volatility for the option. I mean, this thing is super complicated, and he's buying these sophisticated option spreads on top of that. You would not be able to explain this to the average person. It's doubtful he really understood. In fact, it's probable that he didn't understand it. He leveraged up like crazy. Everyone's screaming at him that he's going to lose his money, and so as his trade was going on, he ended up taking out his profits. So he put in $5,000.
Wow.
He took out $10,000, but kept the majority of his position open. The following day, it all went crumbling down. His account went negative, something like $50,000 or $60,000. But he walked away with his money. You know, Robinhood closed his account off. Robinhood ended up stopping box spreads altogether. They prohibited that particular strategy. The guy ended up with a Wikipedia entry dedicated just to him. And he's
what was his
trends.
leverage amount again? What was his? How much did he leverage himself up to? 50 times.
It's been a while, but I'm going to go up to $300,000 or $400,000.
Okay.
If I'm not mistaken, it's happened so many times I've lost track. But his particularly was from 5,000 to about 3 or 4.
So he gained 5K. What happened to his losses? Robinhood closes his account, the losses just go away. That was actually a running joke I read on WallStreetBets. Like, oh, if you have a bunch of losses, just close your account, they go away. No, that's obviously not true, right?
So in order to, when I made this book, I reached out to as many people as possible, and some people spoke to me, some people did not. He pulled it off, right? This was the first time that Robinhood experienced this. I have no idea what goes on internally. I just know that he closed his account, or Robinhood closed it out for him. He never ended up being liable for it. That's not the same story for other people. Other people that November of last year were made liable for their losses. Yeah.
One thing I've learned from WallStreetBets is that the culture of risk-taking hasn't changed at all since 2008. In fact, it's probably exacerbated by platforms like Robinhood that have $0 commissions. Now, one of the individuals I was reading about, he actually posted a YouTube video levering himself up to what he believes is his personal risk tolerance, which was 25 times. He ended up betting everything on Apple, I think it was either calls or puts. Anyway, it went the other way. He lost 78 to 90% within the first 10 seconds. He ended up getting a lot of views on YouTube and became really pretty infamous that way. Why is it that this culture of risk is still very much prevalent with us today, you think, after everything we've seen, everything we've witnessed in the global financial market since 2008?
They have crappy role models, right? They saw the other people do it. If you look at, you look at a ton of examples throughout the history of Wall Street, if we want to call it that, people involved with the financial system on an international level. There was this guy called the London Whale, something like that. He worked at JP Morgan. He was working with credit swaps or something like that. And he would end up doing similar things, lost millions of dollars for his firm. You've had traders also, I think, in London that were drunk one day and they were just pushing buttons and they bought so much oil, they pushed the price around. So you have people that are doing it anyways. They're doing it with massive amounts. And so you have these kids that say, okay, well, I have $250 or I have $1,000. The most that I can lose is this amount of money. Let's go ahead and put it in there. Some people actually make a ton of money. Surprisingly, to my surprise, more people, after they make this huge payday, take their money and they walk away. They leave some money there and they keep playing around with it. There's some big profile examples where it's not the case, but these guys are just hoping for a big cash out. Just like if you win a slot machine, you're not going to win it again. Mm-hmm. They take their money, they leave, and they're risking what they have, no different than someone would risk when they go to a casino.
Yeah. Has anyone ever approached you and said, hey, I lost a lot of money and I learned all these things from WallStreetBets. I need you to shut down this site because it's not good for other people. Have you ever encountered that before?
No, but I'll tell you what worries me more is when people make a lot of money and in a profile where that is much more damaging. When somebody loses a lot of money, it lets everyone know, it reminds everybody that what they're doing is risky. So they already knew that going into it, but it's a subtle reminder. Sometimes you just get a little lucky streak, it gets to your head that this is what you're going to do for the rest of your life without really realizing that they were likely lucky. And so when somebody makes a huge payday, people decide to coattail, people decide to dream that same way, and a lot of people end up getting hurt. The fact is, statistically, most people lose money when they do this particular type of strategy. I think that's why they go all in with a few $100s at a time, sometimes walking away with as much as, $125,000 from a $900 or $700 bet. So they're going for that one. But when you have these big wins, it encourages more risk and it makes people forget that it's risky, whereas it's the other way around. I've had no people that wanted to shut it down because they lost money. I did get a message one time from a dad who was concerned, and that resembled more of a family issue. And I spoke to him on the side, but it was, it was just a one-off.
Okay. Well, you're right. I mean, big gains are often, they're posted and they're upvoted and they talk about them. They spread like wildfire, these stories of big gains. You talk about a couple hundred, even a couple of $1,000s to hundreds of thousands of dollars. I've seen posts like that before. What's also surprising to me is how much losses are being encouraged to be posted. What are your thoughts about that?
I think that's part of the reason why WallStreetBets is popular. I think it's a refreshing level of honesty which people appreciate. If you do go to other forums that resemble it, whether they're for professionals or whatnot, you have a lot of guys that say, look how much money I've made, and look at my car, and look at this great lifestyle, and it's just showing, and look at my great win rate. And it's always positivity. And the people that know the people that have been around the block know that they're just showing the good stuff and they're forgetting to show their losses. Yeah. You go to WallStreetBets, you put it all on the table. You're being completely transparent with everything. People give entertaining feedback, sometimes really funny, sometimes cracking some jokes, and sometimes very intuitive or very helpful, knowledgeable answers. Mm-hmm. But the discussion that takes place is a really honest one. Some guy will come in and say, well, I read all of the financial documents from this company and they're going to do the IPO or their earnings and this, and they'll throw this big sophisticated analysis, which is really helpful for a lot of people. And then other guys will come in and get the same amount of upvotes to say, well, I live with my parents and I decided not to go to college because the Burger King was offering better with the drive-thru, and they just completely make a mockery of the fact that they don't know what they're doing. But I do think that you should buy Tesla because it has a ludicrous button. They'll put a funny video. And it's celebrated. Yeah.
I know people personally who go all in on option chains, on stocks on companies that they don't even know what the companies make. It's just like, okay, my friend's doing that. I'm going to make a bigger position, and I'm going to see if I can out-gamble him. I think there's this culture. I think there's a culture here, not just within Wall Street Bets, but of younger traders in general that I've observed, of sort of us versus them being the older generations, the more traditional methods of investing. I'm on Wall Street Bets right now. There's this meme that I've noticed. It's called the Great War between WSB and traditional investor boomers. And there's this meme that I can show. But it's like it's seen from the Lord of the Rings. The orcs are the old investors, the older generations, and the good guys are the Wall Street bettors. Do you think this attitude will sort of, it's just a coming of age, or do you think it will become prevalent in the next generation of traders and investors who will be dominating the markets?
I think that these guys are shining a light on the ludicrousness that has always existed.
Okay.
This year, when coronavirus forced everyone into a shutdown and everyone's starting to use Zoom for their meetings, people flocked to buy the Zoom stock without caring about their financials or understanding what they were doing. In a very high-profile manner, the ticker for Zoom is the letter ZM, but they ended up buying a different company whose ticker symbol was literally Zoom, spelled out. And so people would buy this stock thinking that it was Zoom, and everyone's making fun of them. All the guys that traditionally look at these reports or what other seers going, ha, 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 you guys bought the wrong company, you silly children. Well, those silly children made much more money than the people that were investing in the actual Zoom company, so they don't care, right? They had the last laugh. Not only did they not look at the financials, they bought the wrong darn company, and they took advantage of it, and so many people flocked to it. And I guess it was such a low volume stock that the price got super, super pushed. They ended up having SEC had to step in to try and fix that. But they did the same with Hertz. This year Hertz is declared bankruptcy. These guys all sit there and they'll look at the price, and they say, look, the price of Zoom is really close to zero. You're supposed to buy stocks when they're low and sell them when they're high. Well, it's pretty close to low, so let's go ahead and just buy it. We don't care about their financials. In fact, they just bragged about the fact that they have bad financials.
Yeah.
But they pushed the stock up from $2 to $5. That's making 200-something% on a bankrupt company. So they're showing the ludicrousness of a system where everyone was guessing anyways. Before these guys had enough numbers to push the stock prices around, professional analysts sit there and say, well, I'm thinking the forward guidance on this particular sales number and this what's happening, the geopolitical, and they're guessing too. And sometimes they guess it right and sometimes they don't.
Sure. I mean, is that what we should be doing then? Like for the younger traders, forget business school. Just go on WSB, look at what people are talking about, go on that, because the herd's going to push up the stock. But in all seriousness, I mean, how should a young trader wants to learn how to trade, how to invest? What would you advise him to do to educate himself?
Well, first he has to define what it is that he wants to get out of it. It's a boomer question to ask yourself that, but it's important because that's how you can define your path. If you're looking to make money, if you're actually trying to grow your wealth, it pains me to say it, but just buy and hold, index, leave it in there, and don't play around with it. If they're looking to take a more active role and gamble with it, then I'm going to say make sure that they start with understanding that they define their risk. This is how much I want to lose. Be okay with that. Be at peace with that. Expect to lose it. Put the money in and hope for the best. Usually the biggest trades are also the biggest losses. The people that take $700 and make $100 and something thousand from it had a very, 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 very high chance that they would lose that amount of money, much like a slot machine. There's other particular bets that'll end up paying 1-to-1. Those bets tend to have a higher probability, but the payout ends up being lower. So with the guys that are looking to gamble and hope for the best, just understand that that's the point. And for the people that want to take kind of a middle of the road, they want to learn how to trade and they want to really get involved with that. My advice to them is decide whether that's what you want your profession to be, because you can't do full-time trading and a full-time job. It is a very complicated thing, regardless of what the company financials and all that stuff the analysts look at. The professional traders also don't look at those numbers. They're looking at price movements and all sorts of different statistical methods. That is a very difficult craft, one that they could pursue if they wanted to. but it's just as difficult as any full-time job.
I think the first piece of advice you gave, investing in an index fund, if you posted that on WSB as an anonymous user, you get downvoted. I'm pretty sure.
Yeah, I mean, absolutely. If you want to do that, there's a forum for that. You're in the wrong place.
Sure, absolutely, yeah. Anyway, Jamie, it was a fantastic experience talking to you, and best of luck with your book and your future endeavors. Thank you for coming on the show today.
Thank you for having me.
I'm David Lin. Stay tuned for more.